Hello everybody. Today I'll take up another question on depreciation. In my first session on depreciation, I took up a small question. So here I'm taking another question, and this is also based on the straight line method. Now here is the question. A firm purchased a machinery for rupees 2 lakh on 1st July 2010. It purchased another machine for rupees 1 lakh by check on 1st January 2012. Depreciation is charged at 10% per annum by the straight line method. Accounts are closed every year on 31st December every year. You are required to show the machinery account, depreciation account, and also the balance sheet for the 3 years. Now this is a question where there are two machines, right? So for the first machine is being purchased on 1st July 2010, and the second machine is being purchased on 1st January 2012, right? Now here, first of all, we have to make the depreciation account. Now before proceeding to the ledger accounts, I'll show you the journal entries for these transactions. Now when the machine is purchased, right? When the machine is purchased, the journal entry that you will put is machinery account debit to cash or bank account, right? Being machinery or any other asset, right? Machinery or any other asset purchased, right? Now the second one, for providing depreciation, the journal entry is depreciation account debit to machinery account being depreciation provided on the machinery, right? Now finally, when this amount is transferred to the profit and loss account, it is profit and loss account debit to depreciation account. This is being the profit and loss, being the depreciation transferred to the profit and loss account. Okay, these are the three entries that have to be made when the machine is purchased, for providing depreciation, and this is for transferring the depreciation to the profit and loss account, right? Okay, so now I'll take up the ledger accounts. And one more thing is, this journal entry, this has to be shown every year, right? Here I have to show it for 3 years, starting from 2010, 11, 11, 12 and 12, 13. Okay, so this will come for the year 2010, right? 2011 and 2012. So all the 3 years you will be making these journal entries, right? And obviously this machinery to bank account, this will come only when the machine is purchased. So in this question, no machine is purchased in the year 2011. Machine is purchased in the year 2010 and 2012. So obviously that first entry, that will come only for the year when the machinery is being purchased, right? Now we'll come to the machinery account. You should always remember the date on which the accounts are closed. In some of the questions it will be given as 31st March, in some of the questions it will be 31st December, right? So accordingly depreciation has to be provided, right? So here we have this is the ledger account for the 3 years I'm going to prepare. Okay, first of all you look at this date. It's being purchased on 1st July 2010, right? So here the date is 1st July 2010 to bank account, right? And what is the cost of the asset? It's 2 lakh, right? So here we will have 2 lakhs. Now since I have two machines in this case, now I am going to make a differentiation by writing machine 1 like this, right? Okay, now this machine is being purchased on this date, right? And they have written here that the accounting books are closed every year on 31st December, right? So this machine is being acquired on which date? 1st July 2010, right? So you have to see that the machine was with us from July 2010 to December 31st 2010, right? It's not there for the whole year, right? From July, if you calculate up to December, it is 6 months. July, August, September, October, November, December, 6 months. So now you have to provide the depreciation for the first year, that is for this 2010, only for 6 months and not for the whole year, right? So here it is 31st December 2010, you will write by depreciation. Now see, this depreciation, this will be like this, 2 lakh into the rate of depreciation is 10%, fine, into 6 upon 12 for 6 months only, right? Not for the whole year, right? So if you calculate this, $2 lakh into 10% into 6 divided by 12, it will come as 10,000 rupees, right? So that's equal to 10,000, fine. So this is the depreciation that you are going to put here by depreciation. This is for the first year, 10,000, fine. Now that's all you have in the first year, so you have to find out this depreciation. Again you can put it as machine 1 here, so that you know for which machine it is, since in this question we have more than one machine, right? Okay, now on this date itself, 31st December 2010, you have to calculate the balance by balance carried down. So 2 lakh minus 10,000 is 1,90,000, right? Now after this, the second year, this is 2 lakh. Now here, this will be 1st January 2011, to balance brought down 1,90,000. Now see, this is the balance carried down for machine 1 basically, right? Okay, so it will be better if you write machine 1 here. And now 2011, there is no machine being purchased, right? So this is the first machine only which is there in 2011, and we have to provide the depreciation for this whole year, right? 2011, right? So here you will have by depreciation account, again machine 1. Now this year it is for the whole year, 1st January 2011 to 31st December 2011, right? So now here the depreciation will be calculated for the whole year and not just for 6 months, right? So here it will be, you can do it like this, take out this, fine. So this is for the second year. Now this is equal to 20,000, right? For the first year we provided only for 6 months, now it is for the whole year, so it is 20,000, right? So here we will put this as 20,000, sorry, 20,000. Now you will have the balance by balance carried down. So 1,90,000 minus 20 is 1,70,000. Again this balance is for the machine 1. right? Okay, so now you close this. 1,90,000, right? Now next year this balance will be carried down. So here I have 1st January 2012. First of all, you write this to balance brought down machine 1, fine, which is 1,70,000. And if you look at the question, here it is, it purchased another machine for 1 lakh on 1st January 2012, right? Okay, so 1st January 2012 we have the next machine, fine. So here that's the same date, 1st January 2012. Here I am going to put this, sorry, 2012. So here I will have two bank account, and here I will write it as machine 2, fine, and this is how much, 1 lakh, right? Okay, now we come to this, the ending of the year 2012. Now we have to provide depreciation. Now this depreciation has to be provided for both the machines. So here I'll put it as this, machine 1 and machine 2 separately, right? So that so as to make things more clear, right? You can also combine it and put it as 1, but if we do it like this, it becomes much clearer, right? So first of all, for machine 1, it is how much? This is the same amount, 2 lakh into 10 upon 100, 20,000, right? Because that is the, we are doing it by original cost, straight line method. And for the second machine, it is going to be this, which is 1 lakh is the original cost, 1 lakh into 10%, which is 10,000 rupees, right? So that is machine 1 and this is machine 2, right? So here I'll put, for machine 1 I'll put 20,000, right? And for machine 2 I'll put it as 10,000. So the total depreciation is 30,000, right? Okay, now we have to do this by balance carried down. Again you write like this, machine 1 and machine 2 separately. See here this machine 1 is 1,70,000, right? And the machine 1 depreciation is how much? 20,000. So the balance for this will be 1,70,000 minus 20, right? So that is 1,50,000. Got it? And this one, for the second machine, what is the balance here? What is the cost here? 1 lakh. And what is the depreciation? It is 10,000, right? So 1 lakh minus 10,000, fine. So that is basically 90,000, right? So that is the balance, sorry, 90,000. So it is 1,50,000 plus 90, which is 2,40,000, right? So if you see this, balance this, it will be, if you total both the sides, it should be the same. See here, 1 lakh plus 1,70,000 is 2,70,000, and 2,40,000 plus 30 is again 2,70,000, right? So it's like this. So this is the machinery account. So I have shown you how to do it for more than one machine. So we write it separately like this, machine 1, machine 2. Now I'll show you how to make the depreciation account. The depreciation account I showed in the earlier session also. It's a very simple one, wherein you just have to put the depreciation amount and then transfer it to the profit and loss account, right? So here, this is the depreciation account. For each year, whatever depreciation you had put, so first year was, I think, 31st December 2010, we had written 2 machinery account, and the first year the value of the depreciation was only 10,000. So this is transferred to profit and loss account, right, 10,000, and that is closed. Fine. Then the next year this is closed here, right, and next year it is 31st December 2011. This year we provided a depreciation of 20,000 rupees for the first machinery for the whole year, right. This is also transferred. Transferring is always done at the end, so that is always 31st December or 31st March, depending upon the end of the accounting year, right. And then this is, see, this is closed, and then you have 31st December 2012. In this year we provided 30,000 rupees as the depreciation, 20 for the first machine and 10 for the second machine, right. So here by profit and loss account 30,000 rupees. Fine. This is the depreciation account, and the balance sheet, the machinery will always come on the asset side. So this is your asset side. Fine. You will show the value. You will start from 1st July 2010, right. You will have machinery, right, the original value is 2 lakh, right, less depreciation, that was 10,000. Fine. Now you get the value on 1st January 2011, that is, if you deduct this you get it as 1,90,000. Then again you say less depreciation, which is 20,000 rupees, right. Okay. So on 1st January 2012 you get it as 1,70,000, and we buy another machine on this date, right. Okay. So here this is 1,70,000 plus that 1 lakh rupees, right. So here it will be, you can put it as plus 1 lakh, that is 2,70,000, and then less depreciation. For this year it is 30,000. So on 1st January 2013 the value is 2,40,000. 1,70,000 plus 1 lakh is 2,70,000. Okay. So this is the balance sheet basically. So the important thing here is the depreciation account and the machinery account, which I have shown here, right. So this is how it is to be done, and with this I come to the end of this session. Bye.